So welcome to the video. In this one, we're taking a look at Aave. Is it going to thrive in 2023 or is it on life support? So this is often referred to as the central bank of crypto. It is the second biggest money market in cryptocurrency. And I want to have a little look at how healthy it is in today's video. So there's going to be some negatives in this. We're going to look at some of the recent events and then end up looking forward to GHO, their stablecoin release. So we're going to end on a positive, a bit of a happy ending, if you will. So here we have it. This is the Aave token, currently trading at just 55 bucks. So this one is a max supply token. It has 16 million tokens, of which we have roughly 14.2 currently in circulation. The remainder are in various smart contracts and with the Treasury DAO, but that is the max supply. And my question around this is what happens when we actually hit max supply? Because at this moment in time, they utilize the Aave token itself. If we just go over to the protocol here, in the staking, you can see the total emissions per day are roughly 1100 Aave. So this means they're having to pay out 1,100 of these each and every day, roughly around 60,000 US dollars in value to keep people incentivized to stake their tokens. Now the staking of these tokens is obviously quite important due to the fact there is a safety module, so the stakers are actually on the line if there's any bad debt created within Aave. And generally, what does a staking contract do? Well, you get the community members to lock their tokens away, thus reducing the amount of liquid supply on the market and hopefully sustaining a higher market price for the underlying asset. As you can see, this is a 1 year view back of the Aave token, and it has been going down pretty consistently here as per the rest of the market, but the tokenomics not really helping. It is inflationary at this moment in time, 1100 being printed each and every day, and less users on the Aave protocol over time. So you can see this over on DeFi Llama here. It is the fourth biggest protocol by TVL. I know some people see TVL as a bit of a meme, but it is obviously very important for a money market. The number one money market is MakerDAO there, but as you see, that is only on Ethereum mainnet. Aave with V3 and some of the upgrades it's been doing, it is on a multi-chain approach here. So it is on a load of different chains. ETH, some alt L1s and some various L2s as well. There's also a proposal to have it launch on Metis very soon. Now, as you can see from the TVL of the likes of MakerDAO, Aave and Comp down there, these are all money markets. There is clearly a product market fit in DeFi for this. But if we look at the overall TVL for Aave, it has been going down a lot. It was up around 19 billion October 2021 and now coming in around 3.5 billion. So clearly the money has not been that sticky for Aave, which is obviously a problem when you look at this as a business. So here we have the report by Llama. I will leave this in the description down below. Really good financial report here on Aave. So this is the most up-to-date report I could find. Annualized revenue currently at around $17.4 million. So it does bring in good revenues. 17.4 million is nothing to scoff at. They do within this say the numbers do not include the revenue generating potential of GHO, the upcoming stablecoin. You can also see the various markets that this revenue is achieved across, some more successful than others. Cough, cough, Harmony Network being a failure there. So if we just go through this, you can see from this chart, we have the total amount of deposits, the total amount of loans at the bottom, and the TVL in the middle here. So over the course of the last 2 years, during the DeFi season through to pretty much now, we saw this product market fit. We saw a lot of people wanting to lever up. They would deposit their collateral and take out a loan. So of course, when you have exuberance in the market, you get more leverage in the market. And as we can see from this, by this trending downwards, you have a washing out of leverage and people leaving the industry overall. But what we're going to touch on in a minute is why this currently has no signs of having a reversal and why we can expect for further depreciation in the Aave token and the amount of TVL on the actual protocol. Now, taking a look at the ecosystem reserve. So this is the DAO controlled reserve here. And you can see last year it was up over $1 billion. So they did have over $1 billion in that reserve, which could have, backstopped them for many, many years to come. But as you can see, that's trended down badly as well, now down around 130 mil. So the reason for this is due to the fact they've kept the majority of their ecosystem reserve in Aave. They haven't diversified it. So 74% there in Aave tokens. And if I can just show you this, you can see at the bottom here, the total across all these various assets, and they do have quite a bit of stables here, 132 mil. So from over a bill, 90% drawdown to 132 mil is not that great. As you can see, 6 mil of USDT, 10.5 DAI, 14.5 USDC. So they've got plenty of runway in terms of dollars, but could you actually liquidate 97 mil of Aave today on the market at that price? Not a chance in hell. So we'll continue on and now check out this income statement. So this is kind of the P&L. We're going to look at these two columns, November and year to date here. So these are the revenues they achieved on various chains. So Ethereum with their V2 release, Ethereum with their V1 release, Ethereum Arc, Ethereum real world assets. Then you've got the alts like Polygon, Avalanche, Optimism, Arbitrum, L2s down there, and Phantom. So in the month of November, total revenues across all chains, just over $1 million, but the liquidity incentives they had to give out was $148,000. So this is where you're incentivizing users with the Aave token to come and put their collateral down. Staking rewards, again, that community incentive, it's around 8%, I believe. Yeah, 8.5% APR. So those 1,100 tokens emitted every day totaled 2.3 mil in the month of November. Third-party expenses as well, just over $1 million. So when you've got your revenue, $1 mil, and then the total cost of sales, 3.5 mil, this means they were in the hole for $2.5 million. So in terms of, is this a healthy business or not? Clearly, the answer is not. And when you look at this on an annualized scale, total revenue, $22 million, total cost of sales, 104 mil, leaving you with a P&L of a rather bad minus 82.7 mil. So one of the major issues that clearly they've stumbled into is the fact the treasury is heavily skewed with Aave tokens. So what they should have done is diversified more out of Aave during the bull market and accumulated more stables, in my opinion. And I think this is a lesson that a lot of DeFi protocols and others, all these teams that are managing treasuries, are now learning that they have to diversify, as investors do, into a heavy stable position during a bear market. So on this overview, yes, they have 132 mil in overall treasury assets. Somewhere in the region of 30 mil of that is in stablecoins. So can they last the bear market? Well, yes, most likely. They've also got some backers as well, so they could, of course, raise more funds. But is this a healthy business you would want to invest in the real world? And the answer would be no. So a major reason for the lack of use case here, and the reason why it will see further depreciation, is due to the fact the selling point of DeFi and its yields was the fact they were higher than in centralized finance, but that is no longer the actual result. So if you just look at some stable coins here, if you deposit, you supply your stables onto the Aave protocol here, you're going to get roughly between 1 to 2%. So this is not an attractive bet right now. And this is why we're seeing money leave the crypto space. Because if you go and look at the US Treasury yields here, you can see they range from around 3.5 to 4.5%. This is seen as the most risk-free form of yield out there, as it is, backed up by the biggest economy, USA, or as some would say, the biggest military. So why deposit your assets on Aave protocol for 1 or 2% when US Treasuries are paying out up to 4.5% right now? That is the major issue here, and that is why I hear people talking about Aave as being dead. But of course, we know crypto is cyclical. These yields will come back once again, but it's how do they manage things in the future to ensure they don't take these wild drawdowns in both Treasury and the Aave token and try and make it more sustainable business, because as you can see, this currently is not sustainable. Now, a recent issue they also experienced was this guy here, Mr. Avi Eisenberg. You may have heard of him. He's pretty much going around the DeFi protocols and seeing if he can break them and extract value from them. So this is a quick brief write-up on Aave and his exploit here of the Aave protocol, and of course Curve as well. So famously, this guy was playing around with the Aave platform and borrowing a load of Curve to short it. So just a quick TLDR on this one. This guy was also known for the Mango Markets exploit. So he deposited 40 mil in USDC to Aave to borrow Curve. He then sold Curve USDC and subsequently redeposited USDC back to Aave to borrow even more Curve. So he was pretty much trying to max out the amount of Curve he could borrow from Aave and keep rinsing and repeating this. He built up a 100 mil position on Aave, paying up to 300% APR and borrowing 83 million Curve tokens using 50 mil of USDC in total. His actions saw Curve go down from 60 cents down to a price point of 40 cents. There's been a few explanations as to why he would do this. One of them was he was trying to hunt a liquidation of the CEO of Curve. and another is that he was trying to exploit Aave itself. So more on that. So after some investigative work, individuals pointed out this: Aave might have been actually utilizing the Aave protocol here to force a large curve price increase, combining three tools. One, the Aave protocol liquidations, i.e. that smart contract that would step in and ensure they liquidated his position. Plus he targeted curve due to its relatively illiquid on-chain markets. And he was betting on the fact that traders and curve devs would try and stop hunt him. Therefore, his trade long curve and short Aave potentially. This meant that Aave holders were in for a scare here as the curve price started to rise from 40 cents all the way up to a wick of 75 cents here. The Aave liquidation engine was set to work on Aave's position, buying up curve. In a 1 hour period, there were 350 separate liquidation events, shooting the price up as we see on screen here to that 75 cent price point. Overall, this actually meant the Aave protocol was left with $1.6 million of bad debt, and therefore this was socialized by the safety module. The stakers of Aave, as per the terms here, in the case of a shortfall event, up to 30% of your stake can be slashed to cover the deficit. So stakers of Aave got left with that 1.6 mil in bad debt, and those losses were socialized within this fund. This then saw the Aave protocol quickly spin up a governance proposal, and they voted and passed to temporarily freeze a load of different markets that were deemed, volatile and quite illiquid: YFI, Curve, Mana, some stable coins like Gemini, Rai, and Pax USDP. Now, this is neither a positive or negative. You had someone pushing the boundaries of DeFi as far as they go, and they didn't really break anything, but they did leave Aave with some bad debt. On the flip side, it showed that things do work in DeFi, and as you can see, governance stepped in there to try and prevent any further attacks on the protocol. Now, final piece of negativity from me on this is the Aave ARC. So ARC is all to do with their institutional arm, and as you can see here, permissioned DeFi, not a phrase I really like to read. We're excited to announce that Aave ARC, the new permission DeFi liquidity pool for financial institutions, where they're required to do AML and KYC. We can only hope that this is not a precursor for KYC and AML on the Aave front end, as this would really go against the ethos of decentralized finance. So this is just something to have on the radar. If they align themselves with more centralization over time rather than decentralization, I ultimately think it will fail, as decentralized versions will pop up, and 99 times out of 100 in the long run, I believe decentralization will win over centralization. So if you stuck around this long, it is time for a happy ending. Give yourselves a pat on the back. So this is GHO. This is the stable coin that will be coming out from Aave. So they will have their own CDP dollar-backed stable. CDP, collateralized debt position, i.e. you have to collateralize in order to take out this stablecoin at a varying collateralization ratio. So they say this: Go can be launched on the Aave protocol, allowing users to mint Go against their supplied collaterals. So say you've got a load of tokens, maybe it's Ethereum here, and you're willing to supply them for this measly APY. Rather than just get this now, you'll be able to also extract dollars in the form of Go. So in that way, you get your ETH yield, plus you don't have to ever sell that ETH. You can just take out some stablecoins as a loan. And on the flip side to this, if you're borrowing that GHO, you're also going to have to pay an interest on that. So this implementation will make stablecoin borrowing on the Aave protocol more competitive, provide more optionality for stablecoin users, and generate additional revenue for the Aave DAO, sending 100% of interest payments on Go borrows to the DAO. So this is the major thing. And you can see from the business model currently is quite broken. They need a way of increasing revenues. And you can imagine if they get enough adoption of this token and people are comfortable holding GHO and spending it, well, then they can make a ton off the interest. So you supply your assets at a collateralization ratio, then you can mint some GHO. You've got to watch your liquidation levels. If your underlying collateral drops in value quite a bit, you may be in danger of being liquidated. If a user repays the loan or they do get liquidated, the GHO protocol then burns the user's GHO. So here is the diagram they use to explain this. Governance will also have to approve something they call a bucket. So the bucket represents the upward limit of GHO stables a specific facilitator can generate. The first facilitator will be Aave protocol itself, but you can see some interesting facilitators down here. Real world assets, number 2, treasury backed, so maybe other protocols in the industry. For example, what if Compound came to them and has a load of comp in their treasury and wants to utilize some stable coins, make use of that treasury? Well, they could use facilitator number 5. I listened to a recent podcast with Stani Kulachov, CEO, and he says the key difference is that the Aave LPs can mint GHO, so a much more capital efficient way of them creating stable coins. So his slant was mainly on LPs. He also says that GHO will be utilized across layer 2s, and he wants it to be used as payments on the internet worldwide. He specified Argentina as a country where people have to convert to US dollars, else they lose half of their spending power each and every year. So CDP stablecoins are something that do have product market fit. They are generally quite slow to grow, but this definitely will be a bit of a money spinner for Aave. It has lindiness and it is trusted in the DeFi space. Certain parameters that Aave stakers will be able to vote on: the size of the buckets, how much GHO can each of those facilitator modules mint. Also things such as the interest rates, these will be determined by the DAO. There's also a discount as well, so if you are a staker of Aave, you get a discount on your GHO borrow, and this has the dual effect of also incentivizing people to stake their Aave and thus be part of the protocol's safety module. So this would have more back into that safety module, currently at 199 mil. And as they highlight once again, substantial amount of revenue in the form of fees. This is the crux of the situation. They need to make Aave profitable. You're seeing this with Curve USD coming out as well. There's clearly an appetite for more decentralized stablecoins in the marketplace, and these big players in the industry are trying to satisfy that. So in conclusion, they have found product market fit. However, as we can see, the business model is not profitable, and over time, if they just continue down this road, it would eventually cease to exist. Therefore, they're opting to find ways of more revenue generation, and they're going down the stablecoin route. So if successfully implemented, this could be a savior for the protocol and help the Aave token price number go up. Whilst I don't think Aave is in danger for this bear market, if they don't find ways to increase the sustainability and make it profitable over time, there would be a finite number of cycles for this protocol. There's competitors coming, Tapioca DAO is one, so you can expect to see iterations of these money markets, and only the strong will survive. I hope you liked this one. If you did, it's longer than usual. Drop me a like, comment, subscribe, and I'll see you guys in the next one. Peace.